Right, we're yet now for another section on risk management, and we'll pick it up from where we left it last time. We did the introduction of what risk management is. We looked at other components of risk management. We defined what risk is. Now today I want us to look at, to pick it up, I think the last thing we talked about yesterday was risk culture. Talking about organization, I've got different cultures. Some, I've got a poor culture, of course. Any culture that is poor won't yield benefits to the organization. So today I want us to look at the risk management in perspective. Risk management in perspective. Now, as a company to grow, a company must be able to have a certain perception about risk management. And that's why if you look at this slide, one important element, the first important element to note is that financial institutions and organizations are of different sizes. That means they're exposed to different kind of risks. So if an organization is smaller, the category of risk that may be affecting that organization may not be the same with organizations that are large. Therefore, the perception about risk for a small organization, of course, it's just starting. Of course, there are certain things that they are trying to still gain experience in its operation. But when it comes to an organization that is large, they don't have room for any benefit of doubt in whatever dealings they're engaged in. So first of all, we have to know that aspect, that financial institution and any business organization, they are in different sizes. Secondly, and they undertake various business activities. And it is those activities that guide also what kind of risk are going to be involved in an organization. For example, in the banking sector, maybe in the banking sector, they'll be looking at components like credit risk. If a company is into exporting and importing, they'll be looking at risk in terms of foreign exchange risk. The fluctuation in the domestic currency, in this case, the kwacha, in relationship with the dollar, because that's the most traded currency in terms of international trade. Therefore, another component also to note, there can be no single optimal risk management structure for all. And at this point, I want to mention, in relation to the size that organization has and the kind of business, you can't really put on average that these are the risks that the structure of risk that organization will be exposed. It depends with one, the kind of environment you're operating in. If the environment itself is dynamic, which means it keeps on changing, you are likely to incur different kind of risk as the operations of the business continues. Obviously, there will be certain trends. If you look at technology, the world is evolving at a faster rate because it's moving at the speed of technology. So anything that comes along with technology can come along with its own risk. There are certain technologies that companies have not yet tapped into. For example, in Zambia, if you look at the financial market, we don't have the derivative market yet. So if a company doesn't engage into derivatives, the moment they start going into derivatives, the kind of risk that they're going to be exposed to will be different. Certain businesses right now, they haven't gone digital, which means maybe they can't really provide their services using online platforms. Of course, maybe in these other sectors like the financial sector, the businesses now, you find almost it has just gone online. You're talking about e-commerce, or in this case, e-business. Now, so you can't reach at the point and conclude that the risk that a company can face have a certain structure, because as time goes by, technology change, way of doing business change, people change. Therefore, the kind of risk that the company can incur change as time goes by, as situations change. Another point to note in this section is that this fact, notwithstanding, all financial institutions, including all other business organizations, need to have structure designed to identify, one, to measure, manage, and control the risks. That means that as an organization, they must be able to identify the risk that they are having. What kind of risk is the organization being exposed to? Secondly, the organization must be able to measure the risk that have been identified. What's the impact of the risk identified? Because it's one thing to know the kind of risk the organization is going to have. For example, in Zambia, if we take up a business and it's able to say, okay, one of the risks that we're having in the period that we're entering in, that is 2020, we're going to have a problem to do with. There's going to be a higher political risk in doing business. So 2020 to 2021, we're having new elections. Certain businesses, investors' confidence into a country is shaken when it comes to time for elections. Because sometimes, it's not always the case, but sometimes the environment does not become suitable to do business. Secondly, there are promises in terms of proposals, in terms of change of policies of doing business. So can a financial institution, a business, whether it's small, big business, be able to tap into what is currently happening or what will happen and be able to identify the kind of risk that will emerge from the period we're about to enter in? If not, then it becomes very risky for an organization. Because if they can't identify the risk, they can't measure the risk. How are they going to manage something they can't measure? So, in this component of risk management, an organization must be able to come up with, these are the risks that the business is going to be exposed. If I'm into exportation of tomatoes as a business, and I know that the kind of risk that I'm trying to identify, maybe there's a new disease of tomatoes. Already it's a risk, because the kind of production that I'm anticipating or expecting may not be what is going to be on ground. So I've identified that risk, that there's going to be a risk, maybe in rainfall patterns, that is going to affect my production. Already we're talking about electricity being a problem in our nation, or even the sub-region as a whole. Talk of Zimbabwe, South Africa, they're still having power generation problem, electricity problems. But are we able to anticipate even 2020 as a business? So identifying those kind of risks, how will it affect? Will it affect the currency? Already the projection of Zambian economy is projected to grow less than 3%. Already it's a risk, because we know that if the economy can't grow that much, already we're having difficulties in terms of liquidity. So a business must be able to identify those kind of risks and be able to bring them at home, looking at the kind of industry they're operating in. Now, after having that perception in terms of the kind of risk they are going to have identified, they are supposed to be able to measure them. After measuring them, manage them. Now, how can a company manage risk they haven't yet identified? It becomes very difficult. If they can measure the risk the company has, then obviously the control part becomes easy for the company, because they have already measured the magnitude of the risk. Right. Then we look at also financial institutions, organizations, business entities are increasingly exposed to risks due to external and internal environment changes. Now, this brings us to another point, a key point. What are the key drivers of change? Because if we can look at the key drivers of change, they become the same key drivers of risk. Because they are behind foreign exchange risk, they are driving forces. Behind liquidity risk, they are driving forces. Behind operation risk, they are driving forces. So the company must be able to come at a place of knowing what those driving factors are. Because we are living in a business environment that has got external factors and internal factors. So number one, we must be able to note that as a business entity we are operating in a liberalized economy, or the liberalization of economies towards market economy. Just in Zambia, if I look at the kind of pronouncements or agenda that big organizations like the IMF, they are fostering for a free market economy. Which means if Zambia adhere to certain changes, we've just seen how Zambia has moved from really talking about subsidies on electricity, subsidies on fuel. So already as a business must be able to identify the more the economy becomes a free market economy, which means we're talking about, when we talk of free market economy, we're talking about government involvement in the business dealings, or the way businesses are operating. To what extent is government's hand involvement in those kind of business? So free market economy, already we're talking about subsidies being removed. We're talking about government letting more the private sector be the drivers of the economy. So already we're talking about forces not being controlled. If we talk of the exchange rate itself, the kwacha depreciating, if it's depreciating, free market economy concept is that let the kwacha be governed by the market forces. Which means we're talking about, in this case like Zambia, we're talking about the central bank should not step into controlling the value of the kwacha. Rather, they should let the market forces determine. So as a business, we must be able to get at that kind of place. If we are getting towards that direction, or we're going towards that direction of free market economy, we must be able to understand that there's that aspect of the market itself determining what direction should businesses take, and not really entirely looking up to the government. For example, if there's less liquidity, think that the government will take up a certain policy that is going to inject more liquidity in the company, in the economy. If, for example, the cost depreciates, so if a business is into exporting and importing, so if it's into importing, the external goods have become relatively expensive. Then if it's into exporting, our goods have become relatively cheaper. So we can't yield so much profit from production that we are in, and our exports. So that part has to be factored in. Now, the deregulation component of business. Every sector of business has got regulators. It has got regulations. For example, if you look at the consumer competition, is it Product Commission, CCPC in Zambia, that regulates competition amongst businesses. Of course, there's that protection that is given to certain businesses. If it's to do with investors coming into the country, we look at policies that have been put to say, okay, let's favor first the domestic economy, let's favor first the domestic businesses. The practical example is in the construction industry. In the construction industry, currently we're talking about 20% of every contract, it should go to the local contractors. Now, what if it comes at a point where we deregulate that component and let it be a free competitive field for contractors? Which means if the domestic contractors, or the local contractors in this case, cannot compete with the foreign contractors, which means all the contracts will be given to foreigners. But in the market, in the free market economy, those are certain kind of policies that where we're talking about, okay, let the market itself place demands. If people want high quality, the local contractors can't provide that quality. Already you're talking about the risk of losing out in terms of customers. Already we're looking at in our country, we can't help it but just to know that China is an emerging superpower. So almost every big business that is on the horizon, it has to put up links with China. If we talk of production, all the machinery right now is coming from China. Now, if we look at that aspect of deregulating, so we are saying investors, when they come into the country, they have to compete with the locals. Businesses will be exposed to certain risk, which means small-scale businesses, some of them, they'll be taken out of the business. Already, we're talking about manufacturing. If other companies are coming into the country to manufacture, whatever they manufacture, what if they don't take it to the local economy, they take it out? And if other small businesses, all they depended was in the importation of goods instead of manufacturing. So if another bigger giant comes into the economy, they have to shift their way of doing business. Otherwise, if they still maintain the same way of doing business, it becomes risky. Now, let's come to this component, another key driver of risk, or key driver of change. Because if there's change, there's risk. Change always comes with risk for every business. So let's look at globalization and cross-border dealings. The world is now slowly being intertwined into one unit or one system. What affects China affects Zambia. So as a business in Zambia, we must be able to understand that one component, today we're talking about the kwacha depreciating. The past few months, slowly going into a year, we've seen the trade war between China and the US, because the US has come up with policies of supporting the local industry, which already it has permitted for exports for the US to go up. And with Chinese businesses, the US is the biggest trade partner to China. Now, if the biggest trade partner to China is no longer now getting things from China, but they want to get them from their own nation, that already has pushed the US currency, the dollar, to appreciate in value, which we're seeing in true reflection with our kwacha. That, of course, there are other factors like maybe load shedding, so production in Zambia has gone down literally. But we're also looking at this component of globalization, that what is happening between China and the US, and us being engaged into international trade, and what drives our currency being relative of higher value than the foreign currency, are factors of production. But also, we're looking at it from the other side, that if the dollar is becoming more powerful than the kwacha because of what's happening in the US economy, so globalization is affecting businesses in Zambia. So as a company, as a business, as a firm, we must be able to come at that point of understanding what's driving the risk. And part of it is globalization and cross-border dealings. If today we know that, especially from the Copper Belt side, and even other people are doing businesses with Congo, if there are political tensions in Congo, we're looking at certain people stop importation of certain goods from Zambia because the business is not favorable. Okay, practical example is the recent xenophobic attacks in South Africa. So every businessman that deals with goods in South Africa, they have a problem. One of the risks they were exposed to is that they couldn't take businesses. I think we saw even a certain truck driver, because they were fostering for businesses being prioritized for the locals like South Africans. So Zambian businesses, they couldn't take certain products there because if they have to go there, the priority is the locals. But again, we're also looking at it, what if a Zambian person has got an external business operation in South Africa, and because of the xenophobic attacks, they're saying, okay, these are the people who are taking our opportunities here. So already those are risks that are involved. But if you look at that, that is to do with cross-border dealings. So as a company in Zambia, there must be that awareness that if we engage into cross-border dealings, we're exposing ourselves to a certain category of risk. And that becomes a key driver component of risk that the company will be having. Let's look at this component, which really no company can affect this component. Changes in technology. In short, change into information, communication, and technology, ICT. Every company, okay, let me bring down to Zambia. Before the imaging of Airtel money, MTN money, these mobile money networks, we had what is this company called? This parastatal company that was sending emails, post office. Post office was in the business of sending money and receiving money, like helping people to send money from one end to another end. Where is post office today? Right now, they need liquidation, or they need, for them to continue in business, they need capital injection. Otherwise, they've been taken out because of technology. They had that technological platform called Swift Cash. Where is it today? Now imagine if post office was not parastatal, it was a private company. Maybe you might be in the position of being the one leading that company. But if you went to sleep, technology bypassed you. Look at what has happened right now to post office. It has been taken over by these others. Right now, the banks are having a hard time because people are no longer taking money to the banks, but they're keeping money into their mobile accounts. So already it's becoming a competitive ground for doing business. Now imagine, that's just a particular example that we've just outlined. What about the business that you are about to engage in? What about the business you're already operating in? What kind of changes in terms of technology that is affecting you? So already, if you're not aware to look at the ICT as a key driving change in terms of risk. One, which means you haven't identified. Secondly, that means that you're not able to measure it. And if you can't if you can't identify a risk, how can you measure something you haven't identified in the first place? Secondly, you can't control. Therefore, that risk will have a negative impact on the business. So right now, post office is trying to catch up. The only way they're going to get back in business the way they were is to tap into new technology and be able to give the same service that these mobile providers like Airtel Money and MTN Money are offering. Now, we've seen this, that the banks, let me give you a practical example. The banks have shifted because they've seen that Airtel and MTN and even Zamtel, they've taken away the business of sending and getting money. Look at now, they've brought in now the platform of e-commerce that you don't need a card, you just need your mobile phone. You can keep money in your mobile phone. Now we're having, we're slowly going into paying like the way it is in China. You don't use your ATM, you just use that code that you just go with your phone and you can make payments using your phone, no card. But if banks are not careful, they've been taken out in business by these other platforms of payments. Because right now, it's interesting to know that you can pay goods from China using Airtel Money. Which means, in the past, we needed to go to the banks. So if the banks don't have money, so whoever depends on the bank to be profitable, for their business to be profitable, they'll be able to understand the kind of risk that it's no longer now the bank that is going to be supporting their businesses. But if you look at that, that is just to do with change in ICT. Change in the information and communication technology. Then the last component in terms of maybe that we can look at in this class, in terms of looking at the key driver of risk or key driver of change, is changes in the balance sheet management. Now, of course, just from its name called the balance sheet, or statement of financial position, like the new name that it carries, if you can't balance your company using your balance sheet, your liabilities become more than your assets. Therefore, you have got more claims than actually what you have as your assets. Therefore, the business already it's going down. Now, at this component, already that's a risk in business. You're having more liabilities than assets, which means whatever cash comes into your company has to go to someone else's pocket or has to go into someone else's account, because you don't have assets. You've got more liabilities. A bank that has got more liabilities than assets will go into bankruptcy. And what we've seen companies that have gone bankrupt. And one of the key components or key causes of bankruptcy is failure to manage well the balance sheet of the company. And here we're not maybe going to technicalities of what the balance sheet, just simply your assets and your liabilities. If your liabilities are more than your assets, you soon go into bankruptcy. And if your assets are more than the liabilities, you are a high profitable company. Which means you are able to sustain the ongoing company. Because what is an asset? An asset is simply something that will be able to generate income for the company. What is a liability? A liability is just anything that takes money away from the company. It's a liability. Okay, so let's look at all these. If you look at all these components, all these drivers of risk, they've got an impact on capital and earnings. So whatever earnings the company has projected, these drivers of risk have got an impact. Okay. There's a blueprint of risk management, and in this case we call it the risk management architecture. We've already established that risk management is a practice with process, methods, and tools for managing risk in a business and or industry. It provides a disciplined environment for proactive decision making. Now, we're looking at it assesses continuous what could go wrong. So, that's what we call the risk. Secondly, we're also looking at it determines which risk are important to do with in the first place. So from the previous discussion, we've looked at, okay, if you're operating in a certain environment, industry, maybe you're in the construction industry. Already there are certain risks that you must be able to identify. So if you're in business in the construction industry, there are risks that you're exposed to. May not be the same with the business, somebody who's into finance, maybe lending, maybe somebody who's into insurance. So there's that component. And there's another component that we have to also look at when you look at the risk management architecture. It's called implementing strategies to deal with those risks. Okay, now we have to answer one question. Why practice risk management? I think this we had it in the introduction, but now let's go a bit into details. The driving force for risk management, because if we can't answer the question why practice risk management, then there's no need for us to start evaluating the risk of the company, because if we can know the risk, then we have to know why to manage. Now, firms practice risk management for several reasons. Because some, and this is dependent on, one, the policies that the company has. Secondly, the targets that the company has. So let's look at that. There are several reasons. For example, interest rates, exchange rates, stock prices are more volatile today than in the past. Okay? So if we have to also to look at it from the other side, we are saying business today dealings have become more volatile than in the past. Why? I think if you look at that component from the key drivers of risk or key drivers of change, we looked at ICT. As information changes, we are looking at also a business incurring more risk. So information just changed. Okay, China is no longer going to be exporting this kind of product. Already you're seeing a reflection in terms of maybe a certain business in Zambia being affected. by just by that pronouncement. Interest rates evolve. We talked about how now businesses are so interlinked because of globalization. So if globalization is affecting our businesses, which means we're no longer just seeing the cost of doing business or the cost of borrowing money, just looking at, okay, let's look at it at the Zambian platform. No, we must be able to get to a place of where you are looking at it, what's other external factors. Now, if you can't practice risk management, then you'll be affected by these changes in interest rates, changes in stock prices, maybe changes even in the cost of doing business. So, why practice risk management? So the first component we're establishing is that because all these interest rates, the cost of doing business, exchange rate, stock prices, they are changing. They are not stationary. They are volatile, which means today something is up, tomorrow something is down. The kwacha, we are seeing the kwacha trading in just 2 weeks ago. The kwacha entered into the 14 bracket range, moving away from the 13. So already the kwacha has depreciated. Why? Because it's volatile. It's no longer the way it was in the past. In the past, the kwacha would have stayed maybe 10 kwacha. But as we go on, we're seeing more volatility. Inflation is increasing per day. Why? Because of the evolving of business that goes by day. So we must be able to understand and know why risk management, because of that component. Number 2, there's that significant losses incurred by firms that did not practice risk management. So why should we practice management? I think in this scenario I've just given a practical example of post office. Think post office had a fleet of buses, if I've used that term. But where are those buses now? Maybe because of competition, changes in the way of doing business. So post office has made losses, not only from the business of dealing with buses, but also from the business of sending and receiving money. All right. Improvements in information technology. Improvements in information technology. So why should we practice risk management? It's because information technology is changing every day. People are improving what they knew yesterday. I think just 2 days ago, I came across this quote that says, every 1 year, 8 months period, information changes, especially what you learned. So, okay, rounding off, what you learned 2 years ago has become relevant today. Why? Because of information technology. Secondly, lastly, the favorable regulatory environment. So, new policies are coming up every day. Today, as I'm speaking, they've taken another step looking at butane by Parliament in Zambia. Now, what effects does butane have on your business, on your operation as an organization? What will butane if it is being enacted into law? Because already the process has started. To say, okay, just to go beyond now into voting. Now, if butane becomes law, what effects does it have on businesses? Because already we're talking about, central bank will no longer have the power in terms of certain powers central bank has, in this case the Bank of Zambia has, in regulating the financial system. That power will go to cabinet. Already we're looking at it as, if you look at the concept of business environment, we've got the political environment. So whatever policies will be formulated by cabinet will be affecting the financial system. So already you expect an imaging of risk from that field. The question should you have an overlook over that? So we need to practice risk management because there's such kind of changes, you can't help them. Regulations are changing. So sometimes we call this activity financial risk management. Because at this point in this course, we are not just looking at risk management there's risk management in terms of a site where the business is operating and changes that are happening there, the damage, the hazardous environment. But in this case, we're looking at financial risk management. So we can categorize all those components. Now, moving further, after talking about risk management, what are the benefits of risk management? Risk management in the light of this guy called the Modiglian-Miller principle, that corporate financial decisions provide no value because shareholders can execute these transactions themselves. Is that true? So now let's look at this. One of the benefits of risk management: firms can practice risk management more effectively. There are many tax advantages from progressive tax system. So if a firm is able to practice risk management more effectively, there are benefits attached to that. And we've just looked at the case of post office in Zambia. They've gone into bankruptcy. Now look at the cost that involved just to bail out post office. So if risk management was practiced for post office, the story would have been different today. Now, what about the business you're about to do? What about the organization you're in? If you overlook risk management, therefore, you're going to incur this loss of bankruptcy. But look at the benefit of taking it up and manage it. And I think from the previous class, we've seen that a lot of corporations are not considering risk management. Because maybe right now it may be in its infancy. But the bigger you become, you've seen we establish a component in the principle in terms of risk management perspective that companies are in sizes. Of course, the more elderly you become as a person, the more responsibility is conferred on you. So even a company, the more you grow bigger, the more risk is exposed to you. So the more you have to become more responsible. That comes in with now looking at it from the perspective, the more you have to give attention to risk management. Therefore, also the other benefit is managers are trying to reduce their own risk. If you take in attention to risk management, even as a manager, you're able to reduce your own risk. For example, is it 2 years now, or a year and some months, or if not 3 years, we saw Intermarket Bank going bankrupt. But if you look at the story behind Intermarket Bank, it goes back to management. So if risk management was a priority for Intermarket Bank, it wouldn't have gone out of business. So even the managers would have benefited, because if they prioritize risk management, the benefit is that the managers also would be able to handle their own risk, including losing a job. So those are some of the benefits. Now, in addition, by protecting a firm's cash flow, it increases the likelihood that the firm will generate enough cash to allow it to engage in profitable investment. So risk management, if you're able to protect the little cash you have. Remember, I think we said this statement as we started this course, that we don't grow big to manage well. We manage well to grow big. So the small cash flows the business is currently having right now, the small cash flows the organization is currently having right now, if those are managed well, and in this case we're talking about risk management. So if risk management is given attention, then we're talking about those cash flows are going into more profitable investment. So the question we should be having is, how are we managing even our cash flows in relation to risk management? If you're able to answer that question, then you are able to know that in the next few years of the operations of your business, the business is able to go into bigger cash flows. Some firms use risk management as speculative too. So if they can know the risk involved, they're able to predict what will happen to the market. So like we've said about butane, so if you're able to understand that component of butane, you are able to understand how businesses will be affected if butane comes into effect, how banks will be affected. Because if cabinet today decides, okay, this is how we should want money to be in the economy, print out more money, they can print out more money, because it will no longer be central bank deciding that to be the cabinet. So cabinet has to sit. But how effective will be those decisions? So as a company, that has to be put into consideration. All right. Some firms believe that there are arbitrage opportunities in financial markets. So, now we're talking about arbitrage, talks about the difference of me taking products from Lusaka to the Copper Belt. Imagine the Copper Belt, there's a 30 quarter difference. So already there's an arbitrage opportunity. An arbitrage opportunity was saying there's an opportunity for you to make more profit because in the other region it's cheaper, in the other region it's more expensive. So you get from the lower region and go sell it in the higher region, in the other region where it's more expensive. So there is arbitrage. Now, if you're able to calculate the risk, you know, okay, if businesses in South Africa are going to go down, because certain companies with certain products are going to go down, then as a Zambian business, you know that's an arbitrage opportunity for you to go export in South Africa. Why have we really seen that Zambia and DRC Congo, they're into trade? It's because there's an arbitrage opportunity because of the instability in terms of the economy in the DRC. We're seeing that people are not able to be productive in agriculture. But if you look at the DRC is within the belt of the equatorial region. So they are more favorable. They've got bigger, huge lands. So even in terms of farming, but how come Zambia is able to export there? It's because that arbitrage opportunity, if you're able to see it even within the country from one region to another region. If drought right now, rains are not falling in southern province, they're falling more in northern province. A person who is in northern province is able to enter into a certain category of production because they're able to take goods from northern province to southern. But that can be inter-provincial dealing of trade, but also you can take that into inter-country dealing of trade by just looking at the risk that another country is facing. And you take an opportunity. Even in Zambia, if we know that production has gone down right now, what are people doing? They're now going into solar business. Why? Because there's a problem in Zambia. So that's the benefit of risk management. So if you're able to identify the risk, measure it, you're able to give you an opportunity. All right. Okay, we looked at how it can risk management. What are now the steps? The steps of risk management is that one, it can be avoided. So we're saying avoid it by not assuming risk or otherwise eliminating the hazard associated with the activity. So we're not saying we avoid risk as it's coming, but we're looking at, after understanding the driver of change that is there in terms of risk, we can avoid that aspect. For example, we can avoid being left out in terms of technology for us to understand that, okay, we can avoid that kind of risk by avoiding being backward in technology. The second component is also looking at, okay, how do you manage risk? You can reduce it by taking preventive action. So sprinklers reduce fire damages. No, so in the building, every building that they construct, they put those sprinklers. Or in case there's fire, they're able to quench that fire because of that water. Even as a financial manager, they must be able to, what if there's fire on our finances? How do we do that? Okay, retained and accepted. So you can retain or accept the risk. The other components you can transfer using insurance, derivatives, or alternative business measures. Because even yesterday we came to establish that not everyone is able to access insurance, but what is left out. So critical thinking comes in as a business. Start finding ways, how do you transfer the risk? Okay, now let's look at this last part of our class today, the risk management process. The risk management process, because this process is so key and cardinal. If we have to manage the risk, there is a process. So the question should ask ourselves is, how, if I'm in business right now and the business that I'm engaged right now, or my organization, how do I manage risk? The first step is risk assessment. Risk assessment. Okay? A firm should make every attempt to assess its risk within the contents of both external and internal. Now, we bring two components of management, which is called the SWOT analysis and the PEST analysis. Internal, if we say SWOT analysis, we're looking at SWOT being SWOT. The SWOT analysis is talking about the strength, and this is internal now analysis. We're talking about the strength of the company, the weaknesses, and the opportunities of the company and the threats. That's the SWOT analysis. The pest analysis, we're looking at the political environment. Now we're looking at the external environment. Like in this case, I mentioned butane. Already, if you do the pest analysis, you know that politically, the political environment will always determine now how, if butane is enacted into law, how business will be conducted in Zambia in terms of the flow of money, the circulation of money in the country. So you're looking at the legal. What kind of laws are being passed in the country? Technology. So these are external factors. But you look at the external factors and you come to look at the internal factors. What are the strengths of our company today? If you're into mining, what are your strengths? If you know your strength, you give attention to your strength. What are your weaknesses? You begin solving your weakness, and that's the only way you can be able to mitigate the risk. So if post office today was able to understand the weaknesses that technology is changing, they were not going to overlook that component. If one of the strengths they had is that they were almost operating in every district. So whatever technology you're going to put on the table is going to go in every district. What strength did they have? It's a parastatal. So they can have more capital injection in terms of expansion, in terms of new products that they have to bring on the market. Okay. So in this risk assessment, after looking at those two components, this is also useful. This is a useful process as it assists in understanding the key drivers of risk. Because if you can assess, you're able to know, okay, globalization, ICT, you're looking at, okay, deregulation, okay, there's cross-border dealing, so, okay, how do I assess business in South Africa right now? How do I assess business in the GRC? Okay, how is the business climate in China right now? That already begins to help you to identify the certain kind of risk that as a firm you're going to be exposed to. All right, then after you've assessed the environment, because assessment speaks more of your internal environment than external environment, takes us to the next component. It's called risk identification. So in the process, you've assessed the risk. Okay, you've done the environment check by using your pest and your SWOT analysis. You've checked, okay, as a business, this is our opportunity, these are our threats. Okay, we're having now more competitors. The question now, after knowing all that component, with the knowledge you have about your environment, what are the risks that you're able to identify? So the objective of risk identification is to determine the risk that may affect the firm and document their characteristics. So in the class that we had, we looked at the component of how CEC, Copper Belt Energy Corporation, made a pronouncement that if they don't get an early deal, almost half of the Copper Belt province will have a problem with access to electricity. Now, do you know what that entails? Which means every business that is in the Copper Belt should be able to look at how that risk is going to affect their business, because that's already part of identifying that risk. Now, risk identification may be done through various stakeholders to the firm as well as external expertise. So you bring in experts. Okay, can you be able to? So time and time again, there must be that aspect. Because why do we need external experts in terms of risk identification? It's because the internal experts, it may not be favorable, because let's look at companies that have gone down because of inside trading. So inside trading, it's a business dealing where if I'm a manager for a corporation and I begin doing other business deal, that favors me as a manager, not as a company. So what do? I use company resources to do business for my personal business dealings. Now, if I'm in an opportunity as a risk manager to assess the risk, obviously I won't let out that information to the company. Why? Because there's that aspect. So at that point, you bring in now external experts that are able to analyze the business dealings of the company and be able to say, okay, the direction of the company is not going in the good direction. Okay. Now, from there, you look at now the tools and techniques of risk identification. So in that risk identification process, what are the tools? Documentation reviews. This can be done by conducting a structured review of previous documentation and reports of the firm. So in this case, you're talking about financial statements. Okay, if the business hasn't reached at that point where maybe it's producing financial statements, what about the current book records that you have about your sales of the company? as a company? How is the previous documentation? Therefore, you take it up. This is in order to ascertain whether there are any historical issues likely to influence the nature. So if a company, maybe it has been lending, getting more money, got more money, so it's in debt. So records show that the company is in debt. Why should the company expand its operation when it's having debt obligation? So already that becomes a tool that you use. Use documents. And, and the second one, how you gather information for risk identification. You look at information gathering techniques. Already you're talking about what's happening globally. What's happening in our own country. So you have to listen to pronouncements by government, policies. What is Parliament doing? Whatever Parliament is deciding is affecting businesses tomorrow. So several methods of information gathering can be used to identify risk. For example, brainstorming. Probably the most used risk identification technique. Because remember we mentioned that earlier on that businesses are different in terms of operation, even as their sizes are different. So as a business, you may be in a region where your operations may not be as the same as other businesses that have been there before you. So you must be able to brainstorm. All right. So risks are then categorized by type and their definition sharpened. Okay. Brainstorming can be more effective where participants prepare in advance and the facilitator develops some risk in advance. So brainstorming, you anticipate risk that is not there because you're able to just use critical thinking. All right. Then there's this concept called the Delphi Technique. This is a method by which consensus of experts can be reached on risk. Experts identify but participate anonymously. So how do you get this information? You can now look at how different experts in the industry have said about the operations of the business. And therefore you can gather that information. That can be externally. They may not be invited into the company. They may not be invited into your business. But you can look at what are the trends, what have they said about the trends in the business category that you fall in. So these risks then circulate for expert review. Consensus on major risk is reached because if 10 experts are able to predict what will happen to small-scale business in Zambia, then that becomes something. And that technique you use in terms of gathering information is called the Delphi Technique. So you use information gathering, you can use interviews, like we said, SWOT analysis. You can interview people. Okay, how do you see this? What's your view about what will happen? What's your view about the product we're servicing, the product we're giving? So via interviews. All right, then you go on the checklist. It's also useful for organization to develop checklists. Now, what do you mean by checklists? Of risk-based information collected from past activities. Okay, so if you are into production of millennium, you go on a checklist, and the checklist already tells you to say, okay, every election time, there are more risks. Or every December, because rainfall patterns they're slowly coming to pass, slowly increasing. So you can reach at that point now where you are able to tell that this is what is likely to occur. All right. Then from there, this could include loss, event data, etc. So you have to check, is there any event of data that is missing? And there it will be able to help us in terms of deciding whether what is missing can have an effect on the business. All right. This it should factor the possibility of other risks emerging and being addressed. So if you check your checklist, the checklist must be able to tell you, okay, these are the risks we faced last year. These are the challenges we had last year. So we must be able to say, okay, this is what we're going to do. Plan B will be this for this kind of risk. Then assumption analysis. There's also need to consider the underlying assumption and scenarios used in various operation activities of the firm. So you have to come up with assumptions. Okay, we assume that next year business is going to slow down. Then you put measures in place. And that's how you might get. You assume that, okay, 2020 is going to be less favorable for the company. You put that into consideration. Now, assumption analysis is a technique that explores the accuracy of the assumption. So you're not just assuming, but based on your technical know-how about your business, you're able to assume certain things. It identifies risk returning to the firm arising from inaccuracies. So you're not just looking at, okay, Zambia, this is where we are. No, as our business. Point A, point B gives us point C. Okay, then I'm able to assume that if I go to point D, we're able to make more profit. So you're making an assumption on an accurate basis, not just really just assuming from the blues that this is what will happen. Okay, as a business, I think we're likely to incur this risk. No. Then you are using now this concept called diagramming technique. You are putting up charts. Let's look at charts. What has been the trend? Okay, the trend is showing us that, okay, ever since we entered into 2019, the business has been slowing down. What are the activities governing this? Okay, from the chart, you look at the cause and effect diagrams you are using for the risk. So that component will help us. Then system processes. Also from the flow charts. The flow charts, the cause and effect diagrams. The cause and diagrams that are using. Then similarly, the influence those diagrams have. Because sometimes it's very easy to know the effect of the future when you are seeing it from diagrams of the past. So that becomes a key component. So at this point, we come to the end of the class of looking at the risk management process. So at least we've been able to look at the benefits of risk. We've looked at how to mitigate the risk. We've looked at the process that is involved in the risk. Even as we build on the same concept for these forthcoming classes, at least now we know and understand the process that is involved. Thank you.